Good day, March 4th, 2025. Today I want to talk about momentum in the stock market, specifically long-only momentum, and some misconceptions and misinformation about this subject. Lately, after a long period of quiet period, we see again links to many articles on social media and the blogosphere with articles discussing long-only momentum in the stock market. The message they try to convey is that there is alpha in long-only momentum of in large caps like the S&P 500 and even in small caps. And then there are all those aggregators who distribute these links to these articles to thousands of people who are misinformed by amateurs who pose as quants. These are people who don't have experience with backtesting, they don't understand data mining bias, and but some of them also do it for clickbait. So we will discuss this subject with a few examples. Before we start, there is no investment advice in this video. So we will start with an example, and before we do that, let's look at the performance of the S&P 500 index total return from 1990 to February 28, 2025. The annualized return is about 11.1%, and the Sharpe ratio is 0.63. Maximum drawdown is a little bit more than 55%. We need this to compare the results from momentum. And we start with the following example of momentum. This is basically the strategy most of these articles change or optimize. It's a monthly rebalance of holding 10 top stocks from the S&P 500 based on a look-back period. In this particular case, it's 252 days. And you basically rank the stocks according to the performance in the past 252 days every month after the close, and then you select the top 10 stocks for the next month. This is the basic system. There are no stops. There's no other consideration except there is a filter. You see it over here and here. For example, a little bit here, when the, and here, here, and over here, when the S&P 500 is below its 200-day moving average, the strategy goes into cash, close the positions, basically. Now, for this backtest, we used Northgate data with seedings with delistings to remove survivorship bias. So there is no bias from rebalancing the index at the index level. So this is the performance of the strategy, 12.5 annualized return, and the Sharpe ratio is 0.59. Notice that the Sharpe ratio is lower than that of the buy and hold, but the annualized return is higher by about 140 basis points. So basically, before commissions, we haven't taken into account commissions. This strategy is not anything dramatic in terms of providing alpha, the pure alpha, theoretical, which is the difference between the performance of the benchmark of 11.1% and the performance of the strategy is about 140 basis points, but the Sharpe ratio is lower, 0.63 for the benchmark versus 0.59 for the strategy. Now, before I even try to explain what is happening here, let's talk about this, only the idea that you can get alpha, high alpha from momentum. I wouldn't call it silly, but it may be, because if you could get alpha from momentum, pure alpha, after transactions, then the market would arbitrage it out in a few years. So the only thing you can get is risk-adjusted alpha. So what is risk-adjusted alpha? This is the alpha here, this alpha. It's 3.5%. It's the risk-adjusted. It takes into account the beta. And the beta here is about 0.5, because this strategy is using a filter, which worked in the past. It may not work in the future if the declines in momentum, if momentum crashes fast, the filter will not provide enough time due to lag of a 200-day moving average to close the positions. So the beta will increase and the Sharpe ratio will fall, and the risk-adjusted alpha will also fall. So let's see what they are doing is they start optimizing. For instance, they say, okay, let's put, in case there is a momentum crash, let's put some stop, a 10% stop for stocks. And then it gets worse. It gets really worse. The annualized return goes down to 9.8%. The important thing here to realize, let's go back to the previous chart. And the reason that most of these articles, they go through pages and pages of discussing momentum, but they rarely show any equity curves, is because if you look at the equity curve, momentum was a thing of the 80s and the 90s. You see, momentum peaked in the late 90s. And after that, it has been a struggle. And we have discussed about this. It's because there has been a major regime change in the markets from momentum to mean reversion, but we will not go into this right now. So you see, after 2000, you have this nearly sideways volatility for many years. We can call it momentum momentum periods of winter periods for momentum over here and over here, and then only recently there has been another rally for this particular strategy to new highs. So what they do is they add stop to protect from declines, and then you see here the strategy continues to, the equity curve continues to rise, but then after that it drops. So from winters we went to uphill, downhill. We had summers, and then we have a winter here and also here. So basically they are optimizing. Now, what if we make the stop dynamic, like a chandelier stop? Well, it doesn't get any better. If we move the stop every day and make it relative to the new closing price, it doesn't get any better. In this table, we'll see what happens if we change the look-back period for the ranking of the stocks from 60 days to 360 days, an increment of 60 days. We see that the annualized return increases and then starts decreasing again. And for this particular increments, we see maximum annualized return around 14.8, which is what is being advertised around that level by most articles. So let's take this system. Let's change the original system, 12.49 annualized return, that used the 252-day look-back period, and add a 240-day look-back period, but also remove the stop and add 0.1% commission, and you see the performance drops by about 200 basis points, which is expected. And again, you see here the bulk of the gains were in the 80s and the 90s. So long only momentum in stocks, it's a thing of the past. The market now, it's very sophisticated. You cannot just take a look back period and select a few stocks and expect to beat the market, because the performance here of this system is very close to that of the buy and hold. Of course, the drawdown is 10% less, but you see what is the problem here. The problem is the bulk of the gains are in the 90s and the 80s. And if we go back to the original buy and hold performance, the gains, the annual gains, and you will see that if you run the statistics, are very close to normally distributed. Of course, the 2008 drop presents a challenge, but it's not enough to make the distribution diverge significantly from normal. So we can basically say the annual returns of the stock market are closely to normally distributed. I have an article in my blog about this. So we see here that what they do basically with the long only momentum, large caps, and even in other markets, is they over optimize. They start adding volatility filters. They start adding other metrics to assist in the ranking, and then they over optimize the strategy, and they claim it makes alpha, which is not true. It's wrong, because what they have done is they have over optimized the strategy. And in many of these articles, you cannot even find any equity curves that make sense. I read an article lately, like 20, 30 pages of going over the same and same things about momentum, how in the past it was good momentum, it was good to trade stocks with momentum, and you can use this and that, and then code in Python, and then there was no equity curve. Why? The answer is simple. It's because of this time period here that has provided most of the gains. And then it doesn't look good. It doesn't look good. So this is the simple reason. This is basically what, not only true with momentum, but with many other strategies. Momentum is one of the two basic styles in trading. It's called divergent trading. Mean reversion is the other style of trading. It's called convergent trading. Although I do not agree with these terms, they have been popularized by some people. Some of those people are basically very naive quants who have popularized these terms. But let's accept them. These terms sound fancy: convergent, divergent trading. You should not expect to make any alpha. The only alpha you can get from momentum is if you manage to design a strategy that will be robust enough with a high Sharpe ratio, maybe around 1, and then if the drawdown is low, below 10%, or if you are not that risk averse, about not more than 20%, you can leverage to get the leverage alpha. There is no way to get pure alpha from momentum. And maybe I say, the misconception and misinformation was due to a book published some years ago that allegedly proved that momentum can provide alpha, but as someone, a professor from a university, showed, there was a bug in the software that generated the results, and there was look-ahead bias. And actually, I have seen this type of bias even in the performance of a strategy discussed by a fund manager, especially with languages like Python that do not have inherently guards for, because they are general purpose languages, for look-ahead bias. it's easy to make these errors and, for example, generate strategies that use information from the future leaks and generates the signals. So this is the idea from this video. You have to be very suspicious when someone is trying to sell you pure alpha from strategies in the markets, anywhere. Pure alpha is arbitraged quickly, maybe for divergent trading, momentum trend following is hard. For example, in trend following futures, it's very hard to arbitrage pure alpha because a large component of this alpha is due to discipline. Discipline in holding positions and rolling them over, long-term positions like recently trades in cocoa, orange juice, which by the way reversed to a short recently, and coffee. But this is different from stocks. The stock market is very competitive. There are lots of money invested in the stock market, and any alpha goes fast. Momentum as a style has not been arbitraged out because it's a behavioral phenomenon. People invest in good stocks and they keep pouring more money, but that doesn't mean you will get alpha. So when quants, astute quants, say that trend following does not work in stocks, they don't mean that the strategies are not profitable. What is happening is that people, amateurs, do not understand the language of experienced quants. When experienced quants say the strategy doesn't work, most of the times it means that it does not provide alpha over when compared to a reasonable, appropriate benchmark. And then the amateurs, they misunderstand this and they say, oh, what is he talking or what is she talking about? They don't know what they are talking about. They are fools. Look, the strategy works. Of course, that's not what real quants do. I hope I clarified a few things for those who understand these things. Probably those who are confused deeply by these things maybe are more confused now. I'm sorry, I cannot do anything about it. But thank you for watching and listening. Have a nice day.